We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app. Just as a reminder, you can follow us on Twitter at Palisades Radio, as well as on YouTube, Spotify, Apple Podcasts, Rumble, and Odyssey. And if you find today's episode valuable, please take a moment to like, subscribe, and share it. It helps us reach a wider audience. Now on with the show. I know David Morgan has joined us too, so feel free to jump in as you'd like to here, David.
I had a reason to get a hold of Tom Power, the CEO of Sunshine Mint, and I've known Tom probably 20 years. And I asked him if he'd be willing to do an interview with me on the Wall Street Silver Channel, and that took place. Most of these listeners that are on here probably are aware of that. And there were certain things that he didn't want to discuss that were basically private business concerns. But I think he outlined it pretty succinctly that they are not producing the quantity of blanks that they used to. And he also said the truth, that the dealers are the ones that are marking it up. It's not the mint that's all of a sudden added on these huge premiums. So that's kind of step one. So I would say, and this is basically repeating James Anderson, and I agree with James, the Silver Eagle market has basically become a coin collector market, because you only pay those kind of huge premiums when you're in a collector coin or semi-collector coin. And just to be crystal clear, typeset is when you have the exact same design front and back with the exception of the date changes. That's called a typeset. And the change only took place very recently. So basically from 1986 when the Eagle program started until recently, if you held every year, you would have a typeset of Silver Eagles. Now there are years that you do have to pay up to get them because the mintages are so low. But that just proves my point. Low mintages carry a premium. So I want to just shift gears because I know that, and I haven't heard a lot, folks, so forgive me, but custodial risk, physical, digital, gold, silver, and crypto. I want to just make a statement that I am been requested by one of my silver buddies that lives on the other side of the country to do an interview with him about Tether. And he wants me to do it soon. For those that don't know, I've done, I think it's 27 crypto conspiracy podcasts. They're free for the public, for everyone. Call the top in Bitcoin, got ridiculed beyond belief. I don't understand Bitcoin and blah, blah, blah. Well, I understood it enough to call the top. Anyway, Tether is still very questionable in my studied opinion. And if Tether goes, it won't do away with Bitcoin, but it will certainly put some downward pressure on an already down market throughout the space. So, Tom, that's really all I've got from me to you or me to the 31 listeners. Certainly, I'm open to any questions. I've got limited time. I'm finishing up the Morgan Report, and I'm pretty involved with that right now. But again, thanks for having me on, and hopefully I've enlightened a few people. I really have to say one more thing along the lines of Bob, and I think it's a disservice to ratchet up these premiums the way they've been done. And of course, as Bob said, and I'll just reiterate it, that because the Eagle premiums have gotten so out of hand, that sort of gives carte blanche to every other type of product to get ratcheted up well beyond what I consider a reasonable premium. I mean, if you want to be a coin collector, that's fine. But Silver Eagles are basically supposedly bullion coins, and that's not what they are anymore. So back to you, Tom. If you have any questions or the audience, I'll take them.
All right. Well, thank you, David. Always appreciate having your input here. And if anybody has any questions, just raise your hand or request to speak here. But Jim, you got anything to add there?
Okay, David, in the short term, do you see $2 higher or $2 lower in silver after a $5 up from the low? Thank you.
Can I take the middle ground
Where's
and
your
say
crystal
flat?
ball?
Well, that's a tough one. I don't want people mad at me. Probably more likely low, down. The market's been acting very strangely for a long time, but in recent months, you see these big moves up, pretty good, but then they seem to get knocked down almost every time. And that's the pattern. Probably by the end of the year. Remember, folks, the lowest print on both gold and silver happened on the last trading day of the year, something like the last five times in the last like 8 years. I'm not predicting that. I'm just giving you, again, what the recent history has been.
Yeah, that's an interesting bit of context there, David. I appreciate that.
The funny thing is, for silver, the last 2 years, the low print has actually been at Silver Symposium.
You guys have something to do with that?
It must be the speeches that David puts out. It just generates a lot of short interest, I guess.
I wanted to address the risk, custodial risk, your first bullet point up on top. My little deal about the custodial risk, I'd like to change that word custodial risk to, with this SBF, this Sam Baker-Fried or Bakeman-Fried. I don't think he did this all on his own. I know he's got, in the news, there's a girlfriend there, but he looks like he's about a 25 or 26-year-old kid. I think he had probably some advanced help. And I'd like to change that custodial risk to custodial theft. It looks like it's over $3 billion of losses. And I mean, if you see the kid, if you listen to him, he's been on TV, on CNBC, on a couple different things, couple different channels recently. He doesn't come across as having the financial sophistication to swindle so many people out of so much money in such a very short time. Okay, and his premise is the money's gone. I don't know where it went. Well, that doesn't hold true. The second part that I'd like to just bring up is that if we truly had a blind justice system, the FBI, we already know, they know how to do early morning raids. We've seen it happen to one political party's representatives. And if the American justice system was truly blind, meaning equal justice for everybody, this guy would be in handcuffs already. And his girlfriend would be in handcuffs, and he would be pressured by very fine FBI interrogators to blow the whistle on what happened. I don't understand how this young man is being protected. That's about all I've got for the risk. Thank you.
Well, one of the reasons why he's not, he's in Bahamas, so they have much more relaxed laws when it comes to this kind of stuff than the U.S. And I think from what I've kind of read that the only way they're going to get him over here is if they somehow draw him back into the U.S. Because I don't know if there's extradition from Bahamas.
Yeah, I was just going to touch on that, Bob. Jim, he's 30 years old. He's a highly educated Ivy Leaguer, has a degree in physics and a minor in mathematics, applied mathematics. So this guy's no slouch. He was actually on a space. I just got home. I was driving home from the office, and there's been a space. I don't know if you guys have been on it, but some of you guys have. I guess Bob, I know you've been in there. This guy by the name of Mario Nawal has been running an FTX space for the last 2-3 weeks since this all broke out. And they've had everybody in there. Trump's former communications director, Anthony Scaramucci, was in there one day. Biden's son, Hunter, was in there one day. Kim.com of the 2000 crash fame, he was in there. He's been in there. He was in there today. Anyway, what was interesting is I hopped in there this afternoon on my way home, and they had SBF on there, Sam Bankman-Fried. So we actually spoke for about an hour and a half, answered some questions. He didn't really answer questions. He just kind of maneuvered around questions. But, I don't know if there's if this is a bigger issue, if there's a lot of people are saying, there's probably a lot more people involved here. There are probably more characters involved. I don't know how nefarious this gets, but the fact that he hasn't been, handcuffed yet, I mean, that doesn't surprise me. I mean, a lot of people want to compare what's going on with him with what happened with Bernie Madoff and with others. You guys have to remember, with Madoff within days of getting raided by the FBI, which was in New York City, which has jurisdiction in the U.S., he admitted he copped to the crime, like literally almost immediately. So if you cop to the crime immediately, you're probably going to get arrested immediately. This is a whole different ballgame, right? He's in a foreign jurisdiction. It's a sovereign nation. We have no jurisdiction there whatsoever. They could try to extradite him at some point. They're doing investigations, I'm sure. So anyway, this is going to play out over many months and if not years. So I know a lot of these spaces, that I've been in listening, they all want to jump to conclusions as to what is really going on. People are hiding him. It's a cover up. I mean, I don't know, man. It could be pretty deep. It could not. It may just, in fact, be that these guys were just, using customer funds to just use, party and hang out and dole money out to people. I don't know. I mean, I don't think anybody knows except for the guys that work there. So I think a lot of people are jumping to conclusions. But it's interesting if you jump into those spaces. Like today was really interesting because they actually were able to get him in there. To me, my big question is why in the world would a guy like him want to be on a spaces getting interrogated by idiots? I mean, these guys that were interrogating him, they're just complete morons. They're just complete fucking idiots. And yet they're asking these questions to this guy who's literally just blew up a $10+ billion outfit. I mean, just blows my mind that this guy would entertain being on a spaces with, get this, 40,000 people in that space. So anyway, I just, there are a lot more chapters to this book, I think, over the next God knows how long. But the fact he isn't in handcuffs doesn't surprise me at all. I mean, he's not here. He hasn't been technically charged, as far as I know, with anything yet. He probably will be, most likely. So, it's going to take some time.
Like Sequoia, I mean, you got a lot of big, smart funds that threw money at this guy. I mean,
but that's not surprising either. I mean, think about Bob. Think about in 98, 99. Up until 2000, literally all these VC funds were throwing money at .coms. If you put a .com in your corporate name, okay, your business plan could literally have been on a fucking napkin, and these guys would have given you tens of millions of dollars back then. Does it surprise you that this is still going on today? We have to your point, to this space's point of gold and silver and why we're talking about all this stuff. The liquidity out there over the last 12, 13 years is just unbelievable amount of money has been pumped into the system. So you guys really think they're going to be doing due diligence? I mean, if the guy went to MIT, he's been trading for some hedge funds in New York for a couple of years. He's been fairly well vetted. I mean, think of what you want when I say vetted. I mean, again, Ivy League, MIT grad, high-powered folks that teach at Stanford. I mean, he had the pedigree. So, this guy came out of the woodwork, out of like somewhere in Louisiana backwoods. Of course they're going to vet. They're going to crawl up his ass. This kid was a very well-groomed individual. So this is, I think, why. And by the way, the other reason they didn't really go in and vet too much is because, everybody in the last 2-3 years has been clamoring, trying to put money into this crypto space. It was almost like a badge of honor. If I wanted to take, say 15, 20 million out of my fund and put it into a startup like FTX, I mean, I'd have to get in line. I'd be fucking 100 deep, right? Sequoias and everybody else, and God knows how many other VC funds out of the valley here put money in. I mean, it's really that simple. I don't think a lot of thought went into it for precisely the reason I just said. I think he was just one of those guys. He looked the part, Ivy Leaguer, famous, in crypto circles. And you know what? If you don't give me money, the other guy behind you will. So if you want in, you got to get in now. I mean, you know what I mean? Like the same thing happened in 99, 98. Same shit was going on. No different at all. Zero difference.
Thank you. I've had trouble with the weather here. I'm not hearing everything. I have to keep logging back in. But BTC, I don't know you, but everything I heard, you're spot on.
It's O'Hare, David. It's O'Hare. We follow each other. We've been on spaces together.
Okay.
I can't change my name back. I that's a long story, but anyway, go ahead.
Okay, well, good. Then thank you for the accolade. So I've been saying the same thing, that this whole crypto thing that's going to look like the tech wreck of 1999, when you put a .com, you got all this money, no one cared. It was just, it's just ridiculous. And markets generally tend to go overvalued, fair valued, undervalued. So good point. The other thing I want to bring to everyone's attention is, again, maybe this is tooting my own horn, but I do a lot for free for the public, and you can judge it however you want. But if you go to the Crypto Conspiracy series and you go to number 4, I show you with, it's called Graph Commons, and I put it on my display. I make these little mini movies. And it shows you all the association with MIT in this crypto space. And when you see that, it makes you, at least it makes me think and rethink what's really going on here. And when I wrote my first public domain article about Bitcoin in 2014, I believe, I said my 2 bits about Bitcoin. And I said several things that have come to pass. I said that it will probably, if it skyrockets, watch out, here come the regulators. And I also said at the end of the article, having the background I have in, how do I say it, in heavily documented security situations where you are vetted to the nth degree. Like, they talk to your neighbors, how often does he drive? Do you drive too fast? That kind of thing. Regardless of the background, I was in the inner circle of the co-mint ELENT at Signet Communications Intelligence and Signal Intelligence and Electronics Intelligence. And I say that to say this. There is a lot more going on, I think, at the inception of that than most people realize. That is more conjecture, but it's not just POA. It's because of the documents I have been able to see or vet that I seem to be legit, that indicate that there may be, again, some massive, and I don't see a conspiracy everywhere, folks, but it could be a psychological situation where to get everybody used to it, especially the libertarians. It's, decentralized, it's blah, blah, blah. And all of a sudden they get all this stuff. And then, as my friend John Perez says in the Wall Street movie, Wall Street, it's wreckable. And it is. And it's getting wrecked right now. And what's happening? Regulation, regulation, regulation. And what are most people doing? They're cheering. Well, that takes away the whole idea of being decentralized and peer-to-peer, which is the only way to circumvent the system as it exists already. So, end of rant. Thanks again for having me on. Sorry I got to run, but I always enjoy these, Tom. Thank you for inviting me.
David, could I ask you one question, please, before you leave?
Yeah, sure.
How you feel about Dwayne Nelson's replacement? Are you in favor of that?
Yeah, from what I've had, pretty close dealings with him so far, and I can't say a lot publicly, but I've been working to try to better that whole situation, and it's come through. So, yeah.
Thanks for your time, David. And O'Hare, I got to say, I was pretty confused when I saw your avatar there, and then heard your voice, man.
Yeah, what happened was, just real quick, I was in an FTX space. I'm like everybody else. I learn a lot through spaces on crypto. I have a lot of friends in the crypto space. I don't invest in crypto myself, but when that FTX thing blew, when the FTT blew up, and then the whole FTX saga began 3 weeks ago, I was in one of those spaces very early on. It was like the first or second day it happened. I'm laying on the couch, having my whiskey after work, just relaxing, listening into this space. They literally had 60,000 people in there or something, some ridiculous amount of people. And then this thing popped up while I was in there listening from Twitter saying, hey, we should try Twitter Blue. And while I was in the space, normally I just go under O'Hare, when I'm in this big spaces with my little Jerome Powell dung beetle pushing a pile of turds. But I didn't have that then. I changed my pick and my name to BTC Bro, just to kind of fit in. I didn't want anybody to know I'm listening in. Sometimes people know, oh, this guy's in there, and then I'll hop in and listen, or whatever. So anyway, this Twitter Blue thing. So if you guys don't have it, this is what happened to me. Once it said if you get Twitter Blue, it's $8, and you get these special other features that regular users don't get. And I'm like, oh, that's cool. Let me try that. So I paid $8. But what I didn't realize, and what I didn't read the fine print, is if you do that, whatever name you're using, whatever, like for instance, I changed it to BTC Bro. Once I got out of that space, I went back to try to change my name back to my usual. I couldn't do it. I can change the picture, the avatar there, but I can't change the name until I get out of this Twitter Blue. And I actually went to Apple Pay, because that's how they verify. That's the whole verification process that Elon put in place. It's through Apple Pay if you're using your iPhone. So that verifies that you're the user. So anyway, that's the story of why I'm using this BTC Bro thing, and it's really freaking annoying.
Well, and I think that might be part of because when the verification thing started, when Elon took over, there were some people that were tweeting just random tweets. I think there was one of the examples was there's the pharmaceutical company in the States that makes insulin, and they said, "Oh, insulin's going to be $1 now, or free now, or whatever."
Exactly, yeah.
And it was just a total hoax. Yeah, exactly.
Right. Yeah, so they got to be real careful. Now they added this like thing that says official. Now they're going to add color coding to your verification patch there. I'm just getting I actually deleted, or not deleted. I canceled my subscription to Twitter Blue. I'm going to go back to the old, but I can't. It's a monthly deal, so I got to wait till I think the December 12th. I'm hoping, by the way, when that December 12th, the next day, I'll be able to change my name back. I'm hoping. I don't know, this Twitter thing. By the way, did you guys notice, like, when you're sending a tweet now, I just noticed it today. For a while now, you've been able to add a notification, like status, like, hey, I'm watching football, or hey, I'm watching soccer, or, like a status thing.
Okay.
That's now disappeared on my Twitter now. I don't have that anymore. So that's weird. I don't know if you guys, they're always changing
cost
things,
of progress, right?
Yeah. I don't know. They're always changing things, but say, listen, silver had a great day. Gold's had a great day. All the naysayers out there that have been talking shit about precious metals, I think they're missing the big picture here. The fact that the Fed has been raising rates this much, 4% in less than a year is insane, especially when, kind of where we're coming from. The fact that gold is doing what it's doing and silver is doing what it's doing is huge in my mind, a huge relief, right? There's a lot of demand for precious metals, even in the face of, rising rates. So I'm very happy where we are,
Yeah, that's
the sentiment is certainly changing.
Yeah. And I think once we actually get some type of a Fed pivot or more dovish sentiment, that might be another catalyst. And if we, unfortunately, as much as I hate to say this, if we get more negative economic data, that's going to be another catalyst.
Yeah, there are so many. Listen, there are so many reasons to own gold and silver right now. I mean, the real reason that we're all in this space, while we invest in this space, is because of what's been going on for the last, 12 years, specifically for the last, dozen or so years since the GFC. Money printing just ad nauseum, $9 trillion Fed balance sheet, just absolute monstrosity that they've created. But really, when you think about it, there's so many other reasons right now. I mean, one of the I'll just throw this out there right now, guys. I mean, the fact that you see, Credit Suisse stock trading where it's trading it's down 25% in a week. Okay, it's now $3 a share. It was down to $2.70, I think, I can't remember exactly how low it was today, but there's systemic risks in the credit system right now. And all it's going to take is one bank to fail again. And you're going to see, and by the way, what's interesting is with Credit Suisse, I don't know if this is true. I don't know I'm not looking at their balance sheet. Supposedly, Credit Suisse has been one of these banks that's been fucking around with the price of silver and gold. Spoofing. We've read all about that. That's an ongoing investigation, but other things as well. So there might be some. I'm not a conspiracy theorist, but the reality is the fact that they're having these issues probably going to be a really good thing for anybody that owns gold, silver, or mining stocks. I think, and then the other thing was Blackstone today. I don't know if you guys read about this. They're having liquidity issues as well.
I tweeted it.
Yeah, there are a lot of issues out there, guys. Not just so. In other words, what I'm saying is, like, when you start to paint the collage of why you want to own gold and silver in this environment, literally the collage is just getting bigger every day, right? There are more reasons to own it. And I think, and I'm looking at prices, and I'm talking to friends that are in this business. A lot of people are starting to warm up to the idea of putting some, whether it's a small allocation, 1%, 2%, 3%, up to maybe 5% of their portfolios into precious metals or miners. So I think we're starting to see that wave come in. It's exciting because I think we're going to see another repeat of 2016, by the way.
Well, let's hope that 2016, it was a huge short covering burst of energy, and then it just blew out.
And then it phased. But remember, it phased because we were still in the throes of money printing. The Fed was still printing shitloads of money. The balance sheet was expanding dramatically. So none of that is present today. It's a different backdrop today, Bob. So I agree with you. I'm hoping that that's not the case. 2016 was absolutely fantastic. I mean, that was one of our best years. We had mining stocks that went up 7 to 10x that year. I mean, our performance, now we only had about 22% of our strategy in mining stocks at the time, but that was a massive overweight to our, to our peer group. So, but I'm hoping I think we're on the precipice based on kind of what we're seeing on the precipice here of something very, very, very big for gold and silver. And I've been saying this for a long time. I would not be surprised. I think I've said it in some of your spaces, Bob. It would not at all surprise me to get up on a Sunday, look at prices and see gold up $300, $400, $500 an ounce like that, just a gap up, not even a chance for people to buy. It'll close at 1850, 19, wherever it is, 1900, wherever we get to before this happens, and then literally the next print's going to be 25, 26, 20, whatever. Pick a number. I think we're going to get to that point because there's just too many reasons to own it, and not enough people do. Right. So when you have too many reasons to own something, and not enough people owning it, you may get a mad rush into, especially with what's going on with crypto, what's going on with the credit markets, what's going on with some of these large money center banks. I mean, there's so many reasons. I'm very excited. I think there are a lot of, and I think people are starting to warm up to it. By the way, I've noticed on Twitter as a kind of a litmus test, as a gauge, I've noticed a lot more interest in spaces talking about gold and silver. I don't know if you guys have noticed this. I have noticed it because I'm on Twitter for a couple different reasons. One is just to get some, to mess around and have some fun, but also to kind of gauge kind of the sentiment around certain things like gold and silver, like energy, for instance. We have a big overweight in energy and have for a long time. But I've noticed the sentiment changing around precious metals. People are starting to warm up to the idea. More spaces being run, more people in those spaces, generally speaking. I know we don't have very many in here right now, but I think the reality is there's a lot of other spaces running right at this moment on FTX and this crypto debacle. But I'm just starting to feel really, really confident in the future over the next several quarters. So I'm happy to be on this on this rocket ship with you guys. Really excited. I think it's going to be some big stuff going on.
You got to get George Noble to talk more about gold and silver on his spaces.
Well, the irony with George, I'm telling you, I talked to him the other day. The irony is he fucks around with that portfolio way too much. Way too much. You got to just stop fucking around. Okay? I mean, he started when Nope started, right? When Nope started, he had an allocation to gold and silver. Within a week, it was fucking gone. He's like a nervous Nelly. Gold wasn't working, so we got to get out of it and go to something else. And then he got into energy. And then that stopped working, so then he got out. And now energy's, had a great run over the last few weeks. He's not participating. I literally tweeted out, November 7th, I tweeted out, I don't usually buy ETFs, but if I did, I'd buy TLT right here, right now. It's up like 15%, in 3 weeks. Guess what? He just added it, TLT, to Nope 2 days ago. Okay? And it's like 60% of the long portfolio. Okay, this is the problem with if he would just have stuck with the strategy that he had, he would be so much better off right now. But, the problem is a lot of people, I don't know about George, but I think a lot of people, they want quick. He talks about know what you own. Everybody talks about due diligence and know what you own. The problem is in this environment, no one wants to stick around to really know, right? They just want to move around from one thing to the next, whatever the next shiny object is. And as you guys know, and I know very well, when you have an allocation and you have a thesis built around it, you have to stick it out unless your thesis changes. I don't know how a fucking thesis can change in a week. I just don't know. You're long gold one day and then 3 days, 4 days, a week later, you're not. I don't get it.
Yeah. Well, there's a lot of pressure. I mean,
do you think that maybe it's because he doesn't necessarily believe in it, or like you said, he's just nervous to
well, I think a couple of reasons. I think I'll tell you. I think a couple of reasons, and I think these would be. I think I'm right in saying this. If this was a pure hedge fund, he would have a different philosophy here, because think about it this way: what is his skin in the game on an ETF? That the ETF is charging what 1%, 1.5%, 2%, whatever it is. So by the time it hits his bottom line, he's got to share that with Title, the ETF sponsor. They're getting a big cut. So by the end of the day, you're working for 50, 75 bips. So if you're running a hedge fund and you're charging 2 and 20, let's say just a customary, there's different fee structures, but let's just use up 2 and 20. You have a vested interest in making sure that You're not fucking around. You're going to get paid at the end of the year based on your performance. Right here, it's just like fuck. It's like a stock jockey. I just want to, whatever mood I'm in, I'm just gonna move. And by the way, the other thing is it's other people's money, right? It's OPM. If it were, I hope he doesn't trade his own portfolio that way. I don't know, but I've told him. I said, George, if you were just to calm down and keep an allocation steady for say a quarter, the oil and gas, I loved it. I told him, I said, I think that makes a lot of sense. Precious metals, I loved it. I said that makes a lot of sense. I said at the beginning of this quarter, in September, in a lot of my spaces, including George's, the 3 places you want to be going into the end of the year are going to be materials, precious metals, energy, and consumer staples. Go look at those proxies. Every one of those is outperforming the broader market. If he would have just done that, and that's what he started doing, he would have been crushing it. But the problem is, you get excited. And he spends a lot of time on spaces listening to 100 different fucking opinions. You got so many different opinions. I think that's part of the problem. So I think it's multifaceted. It's the fact that there's not a lot of skin in the game. It's easy to just pull the trigger on a new, whatever catches your fancy at the moment. Something's not working, get out of it and go to something that is working. And that's a very hard thing to do, So you're basically it's just an extremely hard thing to do successfully, right? When you're running a portfolio, you should, I'm not opposed to trading around positions, but when you're literally 80% long something, and then 3-4 days later, a week later, you're not. How does that make any sense? I can't square those two. I don't know.
Yeah, I think part of like the conversation about broadening the tent and the interest in PM, especially in silver, it kind of goes to just like what we have and haven't talked about here. Like I get it, but like you look on the silver side, I would actually argue that what we have in this market is a structural supply deficit driven by a really bad supply situation with a really strong and good-looking demand situation on the industrial side from the future with a monetary call option, right? So I really think the future of silver looks more like palladium. And when you talk about those parts of it, it broadens it out to another part of investor. Because then, okay, if you don't think silver, gold's an inflation hedge, that's fine. Look at the fact that we have a 20% supply deficit, which I actually think is quite conservative in this regard, that silver is going much higher because the modern world
Austin,
depends on silver.
Here's the thing. I agree with you, but here's where I kind of disagree. And I don't think you mean it this way, but a lot of people look to gold and silver as an inflation hedge, right? Oh, it's not an inflation hedge because we've had rampant inflation for a year and gold and silver haven't done shit. But it's not a linear thing, right? You got to smooth out these returns over the next 5 years. When people look back 5 years from now, they're gonna look at it and go, "Holy shit, it is a hedge." That's what's gonna happen. Now, it's like this. It's like a ratchet. It's 2 steps forward, 1 step back. 2 steps forward, 1 step back. It doesn't happen all at one time. And everybody's like looking to gold and silver, going, "Oh, look, inflation's running 8-10%, and gold is not keeping up. In fact, gold is down. Silver." Down. What's going on? It doesn't work. Get rid of it. Right? Until you get that pop, like I'm talking about. I'm just convinced I've seen this happen many times in the past. Just when everybody's given up hope and no one believes in it, everybody's like, it doesn't work. That's when it's going to start to work. And then everybody will pile in. And then you look back 5 years from now, 3 years from now, and go, oh, gold's up to 2,800. Look. And then when you smooth out those returns, then you're like, wow, it is a hedge. It absolutely is a hedge against inflation. And I think, going back to like ETFs, like not just George's. I don't want to pick out George because I think there's a place in a portfolio for some risk, like a note, like some of these ETFs. But, I wouldn't be surprised if George has gold in there by the end of the year. Because again, he's not the only one. All these guys are looking at what's working. If whatever's working is what I want to own. And if gold and silver start to work, that's what everybody's going to want to own, just like energy. No one wanted energy until everybody started wanting energy. And so same thing here. I think what's going to happen is buying begets buying. If you're a PM running money and you don't have an allocation to miners or as gold or silver in some way, then you're running behind. Then your clients are calling you saying, "Hey, why don't we own gold and silver again?" That's what's going to happen.
Yeah, we've talked about this before. I agree with everything you just said. Like my point is, I think that we only talk about that element and we don't talk about the other element on the silver side, which is the fact that the world needs over 1 billion. We are creating about 800 million roughly in there, right? There's a 200 million gap It's got to come from somewhere. When you have a situation where only 27% of mine supply comes from primary, the rest comes from producers and companies that they just don't care about silver, right? It's about copper, zinc, and that. Like, I have no idea what the incentive price is to get silver up to a point where you could make up a 20% gap when only 27% about other companies even care about silver. It's a lot higher than 23.
Well, this is where
AIC
you have
is
to
20, right?
Yeah, no, I 100% agree. And I think, when you think about why to own gold and silver, I mean, you can own it for many different reasons. And with silver, you own it, a large chunk of silver, right? The price, or what is perceived to be driving the price, is industrial demand. And, to me, in my mind, I look at silver more as a precious metal in terms of something you put in the vault with the use of conducting photovoltaic cells. I don't look at it as an industrial metal and then an investment metal. I look at it as an investment and the ability to use it for useful things like technology, electronics, care, different things like that. So I agree with you. I just think at some point it's gonna flip, right? People are gonna go, wait a minute. There's a lot of uses to silver, and oh, by the way, it can be put in a vault. It can be stored for a price appreciation, just as a way to hedge against that inflation that we're seeing. I don't think that's clicked yet.
And I totally agree with both you guys. But Austin, I've been doing this for not the longest time, like over 2 years now, like hosting the show, having all these conversations. Do you have a sense of when that supply deficit is actually going to matter? Because that drum has been beaten over and over and over.
It's a great question.
It doesn't seem to matter, right?
It's a great question. When I look at it, so going into this year, the Silver Institute, and again, I think they're doing the best they can, but I think their data is not perfect. So going into this year, they thought there was going to be a supply deficit of 70. Now it's already to 200, which I really think is conservative, because if you look at the recycling side, they said that it went up by 5 million ounces, which is 20% of total supply. Right. And I just don't see how that's possible with all the smelting going offline in Europe, over 50% offline in that regard. You can just find article after article about Glencore and other companies shutting down facilities. And why I think it matters is, in my opinion, and granted, it's very, very hard to prove from the structure of the market. I think that's why you're seeing these drains from both the LBMA and the COMEX. I think it's getting eaten up by industry. Yep. And silver is a weird metal, right? So with wheat, it's going to go bad. So you can't store it forever. With oil, there's a storage problem because it's very expensive to store. You just run out. With silver, it is going to be interesting. It'll matter when there's enough people that are not willing to sell their silver for the given price. I know it's kind of a cop-out answer, but we have 30 million left and registered right now.
That's a great answer. That's not a cop-out answer. That's part of the thesis of why I think price of gold and silver are going to make that ratchet I was talking about, 2 steps forward, 1 step back. It'll go 5 steps forward, 2 steps back. You're going to see that happen. That's partly the reason for that is what you just described. I think once people wake up, there isn't really that much going around, and I need some of it. All of a sudden, the price is just going to reflect that demand, and it's going to be a function of price begets price. When price is positive and moving higher, it gets people's attention. Problem with gold and silver, to the point of David earlier, or was it you, Bob? Is that 26? You get these outlier years where you get a big move and then it gives it all back, and then you get a big move and then it gives it all back, and you can only go through that process a couple times before you're like, "Fuck, I don't want to be involved in this." This doesn't work, right? But but the problem is, if you think about the context, the backdrop of when those things were happening. That's not the backdrop today. It's a much different backdrop today than it was at that time. In years past. I just think the setup is getting. It's like a funnel, and that funnel is getting narrower and narrower, and we're just, I think, close. It's hard to, these things are very hard, very difficult to time, but I feel like we're getting very close to that point where people are going to just one day say, you know what, I need an allocation to this. Get me in, and they're going to call I'm talking from an institutional standpoint. They're going to call their trading desk. They're going to say, look, we need 3% in all these portfolios, and just start buying it, and that's what's going to happen. They're commodity funds, CTAs, hedge funds, even pension funds. I've noticed, I was reading recently one of the rags that we subscribe to, Pension and Investment Magazine. Even now, the talk has turned slightly favor of precious metals as a component of an overall asset allocation for pension funds, foundations, endowments. We're starting to see the small kind of steps being taken. And again, it's just a matter of time.
Is that part of your thesis towards why we might see, let's say on a Sunday night, just a gap up, let's say like $300 an ounce like you were talking about?
Yeah, I don't know that's partly the reason. Yeah, I mean, I just think that the mechanism for that is it's like what Austin was talking about. You know, that spring is, as when he was talking, I was just envisioning like a rubber band, like a spring being wound. It just constantly just been winding. Right.
The rubber ball under the water.
That's right. And then eventually you wind up, you know, and it's just going to snap back. And like most things, it's like, imagine this, and I don't want to like start talking meme stocks here, but a great example of this was GameStop stock, heavily shorted stock, completely thrown out by Wall Street. There was no research on it whatsoever. Handful of hedge funds just shorted the fuck out of it. In fact, there was like at some point, and I was involved, by the way, full disclosure, with GameStop on the long side. You know, there was like 180% short interest in the stock, which I know. I asked myself the same question. How is that possible? But it was possible. With financial engineering, everything is possible. And so similarly here, you know, and by the way, GameStop wasn't just a one-off. You know, it just didn't happen like in the span of a couple of months. I mean, this was a stock that was heavily shorted for years, 6 years, in fact, before this happened, going back to like 2014, 2015. Okay. How many guys were buying and trying to do a short squeeze on this thing up until 2020? Many guys, and many guys got taken out to the woodshed. Just like on the other side, when you have guys shooting against Tesla, a stock like Tesla, it's a story stock, it's a meme stock. How many guys have been taken to the woodshed, to the graveyard, shorting Tesla? And so similar things are happening in the precious metal space, I think. I see a lot of the same, kind of similarities. It's an unloved sector. It's not very well followed. It's completely misunderstood by many people, by most people. And it's if you ask the average person, it's like, oh, gold. Why would I invest in gold? That's Grandpa's thing. He had a vault in the basement and he had some gold coins in there. That's not me. I have stocks. I have bonds. I have crypto. And I think a lot of it is, crypto's taken the wind out of precious metals over the last 5-6 years. Again, price momentum, right? When you see Bitcoin going from 20 to 60,000 and gold going up $20, you're like, wait a minute, I'm in the wrong thing. I got to get into Bitcoin. I got to get into the Dogecoin and Luna and all this other shit. So I think, again, all of this, when you start painting that collage of what are the reasons to own precious metals and who owns precious metals, more importantly, right? Because most institutions don't, and I'm talking from an institution standpoint, right? Mom and pops own gold, but they're not driving the price. Okay, when a $2 billion, $5 billion, $20 billion, $50 billion, $100 billion fund starts to, put an allocation of gold in or miners in, guess what? They're the ones that are going to dictate the price. And so going back to that question of you're going to see a 400, 500, 600, I don't know, it might be $1,000, and I have no idea. I think there are a lot of people shooting against gold and silver. Listen. If you look at the gold and silver ratio, silver should be $80 right now. Right now, it should be like $80, $85 right now, historically. But it's not, right? Why? I mean, I can't answer that question. Because of that, I mean, somebody said $50 silver. Yeah, $50 would be one stop. That could be the first stop, right? Because I think there's been a lot of people shooting against this particular sector, right? The precious metal sector. A lot of guys shooting against it. Just like everybody thought, I'm just going to short the fuck out of GameStop because I can keep pushing it lower using financial derivatives, right? And then one day they woke up and said, oh, there's a fucking crowd of idiots out here, the smooth-brained apes that are buying the shit out of GameStop. And guess what? You get enough of these smooth-brained apes buying the same stock hand over fist because they got nothing better to do during COVID. Guess what? The price starts to make a move. And then everybody gets on board. And then I'm short 25, 30, 50 million, 100 million shares of this. Now I got to buy it. And no one's there to sell it to me. And same thing's going to happen here. You're just going to wake up one day. I'm going to read the paper. I'm going to go, here it is. And by the way, you guys aren't the only people. My partner and I have been talking about this for a long time. I said this to him like back in 2015. I said that one day we were at the office and we were just having a glass of wine at lunch. And I said, wouldn't it be interesting if one day we just woke up on a weekend? It'll happen over a weekend. Something will happen. It always does. Deals happen over weekends. Blow-ups happen over weekends. Things just tend to happen over a weekend. When it's quiet, all of a sudden, boom, it just comes out of nowhere. Now, what's going to trigger it? I have no idea. It could be the default of Credit Suisse. All of a sudden, Credit Suisse could be on the hook for God knows how much, and unwinding positions. I mean, Credit Suisse goes down. Guess what? You got to believe that Union Bank of Switzerland, UBS, then you got to believe Deutsche Bank isn't, you start to it's like dominoes. All of these banks are connected at the hip. Everybody thinks, well, they're all liquid. It's not the same as 07, 08. I would say it's even worse than 07, 08. It's worse. Go and do some due diligence on their balance sheet. Go to run some work on Bank of America, Citibank, Wells Fargo, JP Morgan. Forget about the foreign banks. Do the work here, right? Because we have the cleanest, most, a lot of these other markets have pretty opaque, even in Canada, by the way, that market's less opaque. But this is a very clean market here in terms of like financials. Just do some due diligence on some of these banks. It's like it's almost nearly impossible to figure out what these banks own. There's so many different sleeves here, there, and everywhere else, off balance sheet here and over there. It almost reminds me of what was going on in the early 2000s with companies like Enron and Tyco, these banks. So yes, they have a lot of cash, but cash is one side of the balance sheet. What about the obligations on the other side? Right? That's what no one talks about. Whenever I hear Mike Mayo on CNBC or any of these other bank bulls, they always talk about liquidity. The banks have tons of money. Yeah, but let's talk about the other side of the balance sheet. Let's talk about the fact that these banks, shitloads of treasuries that they've been holding on to for the last 12 years, paying nothing. And the Fed has just raised 400 bips. What happened to those bond portfolios at the pension funds, at the insurance companies, at the banks? No one's talking about that right now. I have not heard one space talking about the destruction of balance sheets on the part of endowments, foundations, more importantly, banks and insurance companies. All of these entities are struggling right now, big time. There's a lot of stress in the system. On one hand, the Fed wants to raise rates to fight inflation. On the other hand, they're destroying the very thing they created. It blows my mind. So anyway, I'll stop my rant, but I don't know what's gonna be the spark. I just know there will be a spark. And if I'm right, if my gut is right, and I've been doing this 25 years, so I haven't been doing this for 100 years, but I've been doing it long enough to been through some cycles. My bullshit detector is pretty high. I just think that there's a lot of things that are like lining up for a really, really interesting situation for those people that own gold and silver.
Jim, go ahead if you wanted to ask a question here.
Yeah, Tom, I didn't really want to ask a question. I wanted to just address what you had said, that you've been doing spaces for a while and people have been talking about the supply deficits and it hasn't really been helping. I just want to, just refresh your memory a little bit that the longs lost money since February, thereabouts, until, the first day of September this last year. And every single month, the people that took delivery lost money. It kept going lower and lower and lower. Silver I'm talking about, the physical buyers, that kind of thing. All right, now September 1st seems to be the calendar date low, and we're up about $5 from that low, Tom. So now I think that, and also what O'Hare was saying, that I think that there will be more interest generated. And there will probably be more because there'll be more profitable trades now for the people that are, from the bullion banks, because now they can sell and deliver with contango, like Bob talks about, for 20 or 30 cents higher than what the front market is. If we start seeing $24, $25, $26 silver, we might see more people enter the trade. And like O'Hare is saying, some of these institutions, they'll start chasing the performance because you'll see some of these ETFs or some of these GDX type ETFs, they're going to start having performance that people are going to say, hey, I better look at this. And the junior trader is going to say, hey, boss, this is up, 15% in 2 months or 30%, and nothing's up 15% in 3 months or in 2 months. So I just wanted to just refresh your memory, Tom, that we've been in a downtrend. That downtrend looks like it's ended. To me, it looks like it's ended. And I think we've got more upside. That's why I asked Mr. Morgan what he thought, $2 higher or $2 lower first. I was hoping he was going to say $2 higher. I'm $2 higher before $2 lower.
Yeah, Dave is, he's an old hat. So he's going to err on the side of caution, right? He's going to be like, it's $2 lower because we've had a nice run. And I love Dave, but I'll tell you, I'm with you, Jim. I don't even think it's $2 higher. I just think we're going to see a pretty interesting situation happen. Look, we're end of the year now. And by the way, I was just thinking as you were talking, there are a lot of off balance sheet short positions in gold and silver. Okay. But what's interesting is if you look for every ETF out there that's precious metals or related or miners related, there's an offset short ETF. A lot of money has flowed into those. Imagine for a second when that money starts to flow out and have to cover all these guys that are out there, buying the other side. So when you start to put together all the pieces of why things can move much higher, much quicker than people expect, I think it's just going to, you're just going to need that spark. And I think, again, I don't know when that is going to happen. I don't even know if it will happen. I've been saying this for quite a while. Hasn't happened yet. But the difference today is the Fed has, obviously raised rates 400 basis points from effectively zero. It's never in the history of the United States has the Fed raised as the velocity of interest rate increases been as it has this year. I mean, it's crazy, which is one of the reasons why you've had, everybody's talking about the 60-40 portfolios. Stocks are down and so are bonds. That almost never happens, right? Because, theoretically, when equities are down, when risk assets are down, flock to safety into bonds. This year, the opposite. Fly out of bonds, fly out of stocks. I mean, there's a lot of very interesting dynamics going on in the market. Then you have, declining, we're on the verge of potentially another housing crash. I don't know about you guys where you live. I live in the Bay Area, and I was just talking with my partner today in the office about this. Their family owns a house in Marin County. They're looking at selling it. It was his wife's parents' house, but it's owned by by his wife and some sisters, in-laws, and they don't want to sell it. They're using it as a rental. But anyway, the long story short, that house already has gone down 15% to 20% in value, just already this year. And that's Marin County, which is it's like Westchester County. It's a very affluent area. Prices typically don't go down too much, but it doesn't take much of a move. It's that bid and ask spread. When you think about stocks, when you think about any asset, there's a bid, there's an ask. And in housing, which is an illiquid, asset, that bid-ask spread can be pretty wide. And right now, that spread is very wide, and it's widening. So the difference between what you think your house is worth and what someone's willing to pay has just widened even more this year. And again, if prices are set on sales, so if there are no sales, then you can think of what you want. You can think your house is worth. But as soon as there's a sale, now your house isn't worth X. It's worth X plus or minus what that sale was, just like anything else. And so I get excited because I just think there's so many positive things going on that, hopefully one day we're going to have a space. Palisades are going to run it. Bob will be in there. All these regulars will be in there. And 1,000 people, 5,000 people in there because everybody's going to be reading the paper going, holy gold, what's going on, right? What's going on with silver? $100 an ounce. Wow. How is that possible? That's the kind of excitement that I think, we're going to see. I firmly believe that. That's why we're overweight in precious metals. We run it's a mid-cap value strategy, but we're overweight energy and we're overweight precious metals because we firmly believe that and when I say overweight, I mean like 5 to 10 times more than our peer group, which some people think it's crazy. They think it's a lot of risk, but to us, it's the opposite. It's actually not a lot of risk. It's actually less risk because a lot of our peer groups in the banks, they're all chasing financials. I mean, look what happened to the banks today.
Bob's
anyway.
not going to be there because his phone's going to be ringing off the hook.
I hope so.
Or he's going to be on the phone trying to get supply. You've had your hand up for a bit here. Go ahead.
Hi, everyone. Okay, so I have I have a stupid question. Let me put it that way, and it's ridiculously stupid. And I'd like someone in the panel to throw a bit of light on it. My question goes this way. With the amount of silver that JP Morgan has and the enormous debt of the Federal Reserve, is there a possibility that we see a kind of acquisition or merge between these two institutions and they reprice silver to such that the debt of the Fed is erased and the price of silver goes like 50x? That's my question. I know it's stupid, but I'd like to know how that can work or not.
I don't know. I don't know how much silver JP Morgan has. I mean, if any. I mean, is it? That's an interesting question because a lot of times to audit these banks and what they're, the bullion banks, and to actually know what they own is nearly impossible, right? They just kind of they have attestations. They just say, okay, we have X amount of gold. Somebody's checked it off. Boom. Check the box. Boom. Next. I would love to be a fly on the wall in at the New York Fed or at the London, some of the London bullion banks, and just kind of go in there and just do my own sleuthing around to see how much of the metal they actually own. Because I just have a feeling that everybody talks about it's almost like the crypto stuff that's going on right now, because everybody says, oh yeah, we're okay. It's like Tether. You guys were talking about Tether earlier. Oh yeah, we're fine. We have all the dollars back here and some investments in treasury bonds and other things that are liquid investment. Everything's fine. Here's an attestation. Here it's signed off by our CFO. That should be good enough. But if you want to go in and actually do the forensic accounting yourself, well, no, we're not gonna entertain that. I don't know, man. I J.P. Morgan, it's got a lot of silver. Maybe they do, maybe they don't. I have no idea. I know that they've probably written a lot of contracts against it. The problem with financial engineering, guys, is much like what's going on in the crypto space. I have a piece of paper. I'm going to write a contract, whether I buy or sell something. I give it to this other guy. He uses that as collateral. He writes another contract. So this thing can be, it's like a daisy chain. This thing can be passed around to, 100 different banks around the world. And next thing you know, what you thought was 1 or 2 or 3 or 5 times leverage is actually 500 times leverage. Because I owe you, you owe him, he owes him, and pretty soon, everybody's, running to get their money or to get their gold or silver, and it's not there. And then everybody has to go through this reorg process. So I don't know, dude. I just think that the demand is gonna go up. I'm seeing it now. I talk to people that do what we do, professional investors, and there is some interest from guys that have never been interested in gold and silver. They're after calling saying, "Hey."
The cause of my question is actually.
Oh, you were asking the question. Go ahead.
Yes. Sorry. Yeah. It's not about if JP Morgan has the silver or not. My question is, can we see a merge between JP Morgan and the Fed such that the silver silver is repriced so as to clear so much that it clears the debt of the Fed? That's actually the cause of my question. Do you get what I'm saying?
Can I try and answer?
Go ahead, Jim. Yeah, go ahead, Jim.
Thank you very much. First of all, the Federal Reserve is owned by like 12 or 13 U.S. banks. Okay, it's not. The Federal Reserve is not a federal bank. It's called the Federal Reserve Bank, but it's owned by 12 or 13 banks. I would not, in direct answer to your question, I would never think that J.P. Morgan would commingle personal corporate funds with the Federal Reserve. Okay, I think they're trading partners. Maybe J.P. Morgan buys bonds or sells bonds to the Fed back and forth as an institution. But I wouldn't, in direct answer to your question, I will never see J.P. Morgan ever agreeing to commingle their corporate silver or their corporate gold with the Federal Reserve Bank.
Can I add 15 seconds onto what Jim said there? I agree with all that. I think there'd be 2 challenges in it. I know what you're talking about. I think that is more likely to be on the gold side. There's an article that came out a couple months ago. I'll just DM it to you. Basically, a European central banker, I think out of the Netherlands, basically said, yes, the purpose of our gold and our ECB gold is if we needed to, we could remonetize that, then use that to basically write off part of our debt in like a worst case scenario. The problem with silver is a majority of it is used in an industrial purpose. So if you were to like write up silver to 1,000 without market forces dictating that, you'd make very important industries, to at least the powers that be, like solar, uneconomical. So gold, maybe. Silver, I just don't see it.
But also, Austin is speaking about a central bank's own gold, not a private or not a public corporation that owns gold or owns silver merging with a central bank. That's the distinction that Austin is bringing up.
I'm with you, Austin. I think it would happen with gold first. Silver, again, extremely bulky, and that wouldn't be their first go-to move. Bob, do you have anything to add to that?
With gold back in 1980 or in the 70s, Jim Sinclair, which correctly called it, basically picked a number, I think it was around 850. He goes, that was basically the number that represented the government, the U.S. Treasury's gold pile, basically, that would represent the same amount of money that was in foreign-owned U.S. Treasuries. So it would have to be probably something that would be a market stabilizer, kind of like they would do it maybe if it was we were a gold standard or some type of bimetallic standard where silver kind of like in the 1933 Bank Holiday Act, where they had to call gold in because that was the only way to expand money supply was to inflate. In order to inflate the money supply, they had to actually have more gold and then remonetize it that way. That would be the only way that they could come in and do it, I would think, unless they needed to. Trust was breaking down, and you basically was a national security risk at some point, and they needed to tie the dollar with some type of standard or some type of asset that people would see security with. But silver is just they took it out of the monetary system back in the 1870s or whatever. So it does have the same weight, I guess, as gold does. One of the things I was going to mention too, that O'Hare kind of mentioned, what we're seeing today with the silver market is a much more educated professional out there. At least that's what I'm trying to help professionals and institutions, is try to get them to understand the essence of physical over paper instruments. And this has been the fallacy of silver for the last 40, 50 years, as it's skyrocketed up and then crashed back down, as there was reliance on paper instruments to run the price. But if you actually take the physical delivery of it, you deleverage the system and you actually turn it into palladium in a way, kind of like what Austin was saying. And so the moves may be volatile, but it may not come crashing back down because it's too expensive to short, and at the same time on the long side it's too expensive or the margin's too high to actually leverage, and so it ends up being price stabilizer that is more forced on the physical buyer or the cash buyer than it is on the leverage buyer. That's what I've seen happen. That's what Basel III I think was sort of all about for me, was the market is deleveraging and banks are deleveraging. They're getting out of the unallocated gold business, and that opens up a lot of channels, and it takes away a lot of fears of, hey, listen, this thing's just going to spike back down after it goes up $5. You don't have the leverage. The open interest on the COMEX has been dying in the silver market ever since COVID. It's just gotten wrecked, and you see this demand for physical product more and more. And it's interesting. That's why the ETFs, I think if more people become educated about the ETFs, they would run from them and they would just buy the physical metal, store it, and they would have total control over their own property, and they wouldn't have to worry about all the shenanigans that the authorized participants and the custodian and the sponsor play with regard to that structured product.
Thanks, Bob. Hourglass, you want to ask your question now?
Yeah, what's up, guys? I have a sort of a subject to bring up, and then I'm going to follow that up with a question. My main subject, I'm listening to you guys and trying to make sense of like this universe of economy. And what I notice is that, obviously markets are just very cyclical in the nature of them. When there's a bear market in a particular sector or multiple sectors or the majority of sectors, which is what we're experiencing right now, where there's also a bear market in others, a bull market in other sectors like energy that we're currently experiencing. So, that money has to go somewhere. It just doesn't disappear when there's a bear market, and there needs to be liquidity allocating to some place, whether that's the dollar or another sector that's not the majority of sectors. Something is blowing up most of the time. And yeah, just sort of with that in mind, I got into markets starting with crypto and like Bitcoin and everything. And then from there, I kind of dwindled down to like, what is money and all the important things that you need to understand what economies are and how they're driven. And that sort of thing just was like a spotlight to me, and just very interesting thing that I thought I'd bring up. But sort of following up with that, FOMD, Jerome Powell and, the Fed are in the sort of position to dial back from the liquidity that they've been giving to the markets. And, I think inflation, the last report, it went down from like something like 8.2, I think it's 7.8 right now. And so we've dialed back a little bit from inflation, which is the main enemy in this whole war of increasing interest rates. And they have done so much this year, and they've barely made a dent in inflation and decreasing that inflation rate with how CPI is adjusting to that as well, obviously. And the Fed is now starting to drill back after increasing them for so long. I think over the last year, it's been it's been 4%. They're getting to 4%. I think it's 3.7% right now, but now they're in the position where they're starting to dial back from the rate increases. The trend seems to be that they went from 7.5 or 750 basis points now down to 500 basis points. And I think that the next reading is probably going to be 500 basis points, as like the last meeting yesterday, he pretty much confirmed that. They barely made a dent in inflation. Now they're dialing back because Jerome, I don't think he mentioned that he doesn't want to over tighten and like really fuck things up. He's starting to dial back. What are you guys' chances that you think that maybe this next report is 500 basis points? The next report after this one, what are you guys' chances that he's going to actually decrease interest rates, or maybe not even increase them at all, because he really doesn't want to fuck things up and over tighten for that extent? And also, if he does start to either decrease interest rates even further, or maybe not at all from 500 basis points, that's, this is already going to be a signal to the market that we're going to start adding more liquidity relative to what we have been doing before. And so this is going to be a bullish outcome for the markets in general. But yeah, just a few thoughts on the table. I'm kind of like chop them up a little bit, but I hope you guys get what I'm saying.
Yeah, well, I would just hop in just real quick and say, the Fed, when you say 500 basis points, a basis point is 1/100th of 1%. So 100 basis points is 1%. So I think you were trying to say 50 basis points, not 500.
Yeah.
50 is half a percent. If they did 500 basis points, they've already done 400 this year. So if they did 500 next, on the 13th, I mean, we'd have some problems. But 50 basis points.
Yeah.
So,
my jargon is a little, you know what I mean? Yeah.
Yeah. So I think 50 basis points is probably in the cards. I mean, look, they've been talking about raising rates all the way through December, so they're probably going to do it. So I don't think, barring, we're going to get some more data this week, tomorrow, for instance, and next week, some economic numbers are going to come in. So barring a complete catastrophe, I think it's in the cards that they're going to raise at least 50 basis points. I don't think they're going to go to 75, but there's a chance they may. I mean, the track record has been 75, but let's just say 50 basis points. It's really going to be what he says during the press conference. I think what they're probably going to lean more towards taking their foot off the gas here. That's my, that's just my assessment. I think they're going to do 50, and they'll probably say in their language that further hikes are on the table, and we're just looking at how things kind of progress over the next few weeks. So I don't know. I think it's already too much, to be honest. My take is I think the problem with interest rate hikes is they have a lag, so you don't really know how much damage you've done until you're looking in the rearview mirror. And the problem with that is that once you've done the damage, then you're backpedaling and trying to restore confidence in the system. And really, the critical thing here is that confidence, right? Once that confidence is lost, it's extremely expensive to get back. And what I mean by expensive is they're going to go right back to the playbook, which is cut rates and start QE. So anyway, I don't know if that answered your question, but I think you're probably we're closer to rate cuts than we are to further increases, in my opinion.
Yeah, 100%. Yeah, and this is relative to what's been happening. This is more so bullish for the markets. If we increase rates by 50 basis points, I feel like that would be more bullish than bearish. I guess my main question is like, what do you think the next rate determination is going to be following this upcoming 50 basis point increase, and whether that's bullish or bearish for the markets?
I think I think everybody's like waiting with bated breath for the Fed to pivot and cut rates, and we're off to the races in equities, and we're going to make new highs. I don't see new highs because remember, the way equities work is, there are a lot of factors that go into the price of stock, right? A lot of people use multiple like price to earnings, and so I think a lot of the earnings side of the equation, earnings estimates haven't come down yet. By and large, are still pretty high. And so the economy is slowing rapidly. Look what's going on with the reports just in the last few weeks. I think what's going to happen over the next couple of quarters, you're going to start to see earnings revisions to the downside. We haven't seen that yet. And I think when that happens, you're going to see stock prices kind of come lower. My assessment is I think prices, S&P 500, just to throw a number out there, you're probably going to see something like trough earnings at $175. So you put a multiple on it conservatively, like maybe 13, 14, maybe 15. A lot of people say, well, 15 is still pretty high. Yeah, but I mean, it's different. Sometime, it is different than it was 15 years ago. I'll grant them that. Times do change. So let's just be conservative and say, give them the benefit and say it's a 15 multiple on that, right? So that's where I think the problem is. I think the expectations are still pretty high. They haven't been ratcheted down. And if we're right, and you get like a number like, let's say 175, and you put a multiple of 15, you're looking, probably closer to 2,600, on the S&P 500, which is, quite a bit lower from here. Still higher than it was in 2008 in the trough. I mean, we hit 666, on the S&P 500. I still remember the day I was watching my screen. I'm like, holy shit, the sign of the beast. This has got to be the bottom here. I mean, anyway, in hindsight, it was the bottom. But so I don't know. I just think that those revisions are coming, and I think prices are going to reflect that over the next couple quarters. So if you have a full allocation to equities, I would build some cash. I don't think you need to run out. There's all these doomsayers out there. Oh, you got to go and short stocks, get out of stocks, short stocks, getting cash. I don't prescribe to that. I think you can still be in stocks, selective stocks. There'll be stocks that outperform. They've been expensive for a reason, right? Their cash flows, these companies just generate a ton of cash, and it's predictable cash, right? As opposed to like these tech stocks that, have growth rates, but have no predictable cash flows. So, or any cash flows for that matter. So I think when you start to see revisions come down, you're going to start to see over the next couple quarters. And I think that's going to start in earnest at the turn of the calendar. I think that hasn't happened yet for various reasons. One of which is, hey, you know what? Why do it now? Let's wait till, beginning of the new year and kind of clean the slate a little bit. So if you have a full allocation to equities, I would trim, I would build some cash. There'll be some opportunities. Certainly, obviously, be in it, gold, silver, however you want to be in it. I know that guys like Bob like physical. I don't mind physical. I run my partner and I run an equity strategy, so we can't have physical. The next best thing to physical for us is having companies that have proven reserves in the ground. Because imagine, yes, they have operating expenses, but imagine if the price of gold, it doesn't even have to go up a lot. I mean, I'm saying I would love for it to go up $500 an ounce over a weekend. We all would, right? Now, that may not happen, but that doesn't need to happen for us to make money in gold and silver stocks, right? That would be the icing, the big cherry on top of this big cake. But having said all that, I think, having an allocation to gold and silver, energy, I think still going to work over the next few quarters. I think energy companies are just absolutely killing it in terms of earnings. And you're going to see earnings this quarter again for energy stocks, blow the socks off people. And by the way, energy, same reason as I mentioned with gold and silver, the energy allocation for most institutional investors is almost nil, literally to this day, almost nil. And so when that money starts to rotate into those sectors, energy, precious metals, you're going to see, you're going to see big moves, big moves, and then of course everybody will chase it, and then we'll get these parabolic moves. And, you want to be cognizant of the fact that, when those happen, that's when you want to start taking your, some of your gains, taking some of your profits, because things don't, they don't grow, forever. So, but anyway, I don't know if that answers your question. Like I just said, I would be very cautious going into the next couple of quarters, going into the middle of next year. I think there's going to be some shit hitting the fan. NASDAQ's already down, 30% year to date, and it's still high. I mean, there's been a lot of money pumping this market up for a long time.
I think the other thing to remember too is that the base effects are going to start to take effect here. You had these comps that we're seeing right now for the inflation numbers are coming off of like almost zero level. That's going to start to take hold as well and add to what looks like inflation coming down. And the Fed and Powell have been signaling to the market the moves that we have seen them make for a long time. So it's not necessarily that anybody should be super surprised by this. as O'Hare said, I think everybody is really waiting with bated breath to jump back into this market as soon as they see the Fed even blink. Because if March 2020 taught anybody anything, it's that as soon as the Fed cuts, jump in with both feet and hold your nose, and you're going to make a lot of money. And I think there are a lot of people that are waiting for exactly that condition. Does anybody else have any other questions or anything else to add to that?
Just have an allocation, you know, you don't have to have a lot. A lot can be, a little can be a lot, right? Mm-hmm. I mean, if you get the kind of move that we're anticipating, you don't have to have a lot, right? I mean, if you had just say 3 to 5% allocation to precious metals, I think that would be, that would be a great start because literally, most people don't have any. So by having a 3 to 5% allocation, you'd be doing yourself a service. And whether it's precious metals, bullion, coins, Bob touched on, the difference between, and I don't like the term scrap or junk silver because I don't think silver is junk. But my point is, like, you can buy silver eagles, for instance. But, a lot of to Bob's point, there's a huge premium in collecting coins. I'm not opposed to having bullion. I have some myself, bars, things like that, silver coins, gold coins. But in my mind, the best returns you're going to get if the price moves the way we think it's going to move over the next several years is to have good quality mining stocks that have, proven reserves in the ground in safe jurisdictions around the world. I know a lot of people like to fuck around with these penny stocks, and it's tempting. You get some big moves sometimes, but for every one that's going to moon, you get one that goes bust. So I would prefer to be the sweet spot, in our opinion, is in kind of the small to mid cap space. And there are plenty to choose from there. They have operational leverage, these companies. Many of them have proven reserves with histories. And so, and people ask me all the time, well, which ones? And so we own four. We have a very, by the way, our strategy is a very concentrated strategy. So, we have between 20 and 30 stocks in our portfolio. And we call it value opportunity strategy. And it represents pretty much all the GICS sectors, the S&P 500, even the financial sector. We don't own banks. We have some proxies for banks. We have a couple insurance stocks. But suffice to say, it's a concentrated portfolio. Right now we have 24 stocks in the portfolio. We have a pretty sizable cash weighting. So you don't have to go out there and invest in 5,000 stocks. Portfolio could be, for the average person, if you had 50 stocks in your portfolio, I think that'd be plenty. And just, make sure that you're covering some bases in different areas, of the economy. You don't want to put all your eggs in one basket, put a huge bet on oil, or even put a huge bet on gold and silver, or on technology, like a lot of guys did during COVID. And then, they overstay their welcome, and then, you see what happens. So I would say, in terms of which names, go to GDX, GDXJ, and others. There are other ETFs out there. Look at the top 20 names in each of those ETFs. And by the way, you could just invest in the ETF itself, which is fine because those are concentrated ETFs anyway. They tend to be top heavy. And if you want individual stocks, just look at those ETFs. Their holdings are published, and do some homework, some due diligence, as we like to talk about, on the top maybe 10, 15, 20 names, and pick a handful that you particularly like. Maybe you live in Nevada, maybe you live in Canada, and you've heard of a company. Just do some sleuthing, go to their website, do some reading. Oftentimes companies will post conference calls, replays on their websites, listen in on the last couple of quarters calls, read the filings and do it that way. If you're inclined to invest in individual stocks like we do, we don't invest in any kind of structured products like ETFs or mutual funds. So anyway, that's what I would do. Pick a handful and put them in your portfolio. And I would do the same, by the way, in any sector. Just go to a sector ETF, look at the top 10, 20 holdings, pick a handful there, and put those in your personal portfolio.
Well, thanks for all your input there, O'Hare. I appreciate that. Thanks for everybody for your questions. Bob, Jim, do you guys have anything else to add here?
Just stay off leverage. It's fun to play options, I guess, if you have a whim for maybe trying to make a quick buck or something like that. But just be cognizant that these markets are volatile. Silver price does get bounced around, obviously not as much as Bitcoin, but sometimes things don't move the way you think they're going to move. It's notorious in the metals markets, false breakouts, false breakdowns. That happens all the time. But as long as you use a cash position, you can stick through the volatility, because at the end of the day, it's how much you have it when this price ultimately does move is what matters. Not trying to game every single little squiggle. So, but yeah, just try to stay safe.
In other words, don't lever up on margin, right?
Yeah, margin, and yeah.
That's what gets people in trouble, right?
Do you feel like you guys would rather be allocated towards gold or Bitcoin at this moment for like short term, like 3 months, next quarter?
My philosophy on investing is very simple. Your core portfolio should be long term, period, right? 80 to 90% of your core portfolio should be long term over the next 10, 15, 20, 30 years, however old you are. You have to be 50 years old. You still have a 15, 20 year time horizon. The other 5, 10% of your portfolio, take a few swings. I'm not saying you should invest in crypto. I don't understand crypto. I'm not that smart. I may at some point buy some Bitcoin, maybe. I don't know. I'm constantly learning about Bitcoin, but I do mess around. I do play options from time to time when the setups are right in different stocks, and so I think that keeps you interested. It keeps you educated. Keeps you in the game, and it keeps you sharp, right? Because you're always sleuthing around, doing homework, doing some what we call due diligence, right? So I'm not saying you shouldn't go out and take some risk in a piece of your portfolio. Maybe take a flyer in some of these penny stock gold mining stocks. I certainly have over the years, and I can tell you I've had some huge winners, but I've had a lot of them are just duds. You read some article or somebody's you talk to somebody, hey, they're ready to this is happening, that's happening, they're going to sell. There's an acquisition here or there, whatever, and then nothing happens. So the point is, 80 to 90% should be like solid foundation, right? Your bedrock. Then sprinkle some maybe some active trading into whatever you feel like, crypto, penny stock, gold miners, or drillers, energy stocks or tech stocks that have been blown up, whatever. That way it keeps you interested, keeps you doing homework, and you may hit some home runs, while you're at it.
Excellent advice there, O'Hare. Thank you for all your input. I think we'll wrap it up for tonight. It's a good 3.5 hour space again. I appreciate everybody's input and everybody's questions. And
I said to you, Palisades, before, we need to have more of these spaces to educate more people. I see Deborah's in here. See a lot of familiar faces, but this is what I say this a lot. Like, I jump around spaces all the time because I don't like to be in echo chambers. I like to be uncomfortable. Oftentimes, you guys might find me in an NFT space. I have no idea about NFTs, but I've certainly learned a lot about what they are and what they're not. More importantly, I'm in crypto spaces a lot. I'm in like all kinds of different spaces, and because I'm curious. It's for me, it's like a sentiment check on the general atmosphere. But what I'm saying here is, I hope we get new faces in these spaces. At some point, I hope to fill these rooms up. Palisades, you do a fantastic job in your spaces running these things. Bob does too. When you guys are in my spaces, I like to kind of screw around a bit, have some fun. That's just the way I am. We get serious, but we do have some fun and do some crazy stuff from time to time. But money is serious. Investing is serious. So I'm hoping to get more faces, new people in here. I'm hoping to get some of these crypto folks in here. These young people, 20s, 30s, that have never experienced what it's like to invest in the real world with stocks, with whether it's gold or silver or anything. Get them in here, get them educated. That's who we need. We need these younger people to kind of get out of this I'm only crypto blinders on, I'm going to buy Dogecoin and get rich, to in a room like this where you have experts like you guys, like David in here earlier, many people, educate them on what gold and silver is and how it can work in their investment portfolio. New faces. I see a lot of I love to have you guys and we all like to banter around and talk, but I'm hoping we get some new faces over the next few months, and it's going to be a function of the excitement around the precious metals space. I think it's starting to build a little bit. Maybe I'm wrong. Maybe you guys see something different, but I'm kind of seeing that a little bit.
Yeah, I would agree, O'Hare. And it's funny that you mentioned that comment about being in an echo chamber. Somebody giving me some crap yesterday, I believe, on Twitter about points that some of my guests bring up. And my response was just that, I'm trying to listen to both sides of the aisle, to all ideas, so that we do stray outside of an echo chamber and try and get all kinds of input and figure out what things we haven't maybe taken into account and be exposed to new ideas, so that we're not sitting in our own echo chamber. And
Exactly.
that's why I make such an effort to have so many different voices on the show.
Yeah, no, and absolutely. And I think that's what we need. We need to challenge our own thinking. I oftentimes, like it just in my course of business on a daily basis, you get stale. You're like, you know what are we missing here? Let's talk to somebody that has an opposing view and see what they think, see where they're coming from. So it's good to get an exchange rather than having a room full of people that are bullish on energy, like these energy rooms. I'm in a lot of these energy rooms with my Canadian oil mafia friends, and it's always energy, and it's good to have some guys that come in and say, hey, energy, here's why I wouldn't invest in oil and gas. Here's some hurdles that we're going to hit here. So I always like to get challenged, and I think that's what would be nice, to get more people in here to kind of have that dialogue.
Absolutely. All right, guys, we're going to wrap it up for today. Big thanks to Bob, David, Tom Luongo. We'll see you next time. Thanks, everyone.
All right, guys. Take it easy. See ya.
Thanks, guys.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.